Gold and gold mining funds. Is it worth investing in, or is it too late and have we missed the boat? Gold performs well during periods of uncertainty, during periods of high inflation, and during periods when interest rates might fall because gold doesn't pay any dividends or any income. And we've kind of got those situations right now. And it's also compounded by the fact that a lot of governments are increasingly turning to gold for their reserves rather than currencies or things like US government bonds. So on the one hand, you've got these gold bugs that will buy gold no matter what the price is. They'll always say it's undervalued. They'll talk about long run commodity cycles. And on the other, you've got people, mainly independent financial advisors, who aren't so keen on gold. But then when you actually press them and say, look, you actually have any gold funds on your platform, they'll admit that they don't have any at all. And that is why they are so negative towards it, because you just can't invest in it if you're using their services. So here's the price performance of a gold ETF, up over 37% in 1 year. And my view is that if the asset has price momentum, then I'm interested in researching it further. We can see here that precious metals are the top performing sector over the last 3 years. So we can use the website Pick a Fund to find the best performing funds around precious metals, which is what I've selected here. Pulled up 28 results. I've searched on a 3-year return. Number one is this UBS Gold Miners. Unfortunately, it's only available on one platform, which seems to be AJ Bell. We've got the Schroder Global Gold Active Fund coming in number 2, L&G Gold Mining, Baker Steel, Ruffer Gold. So you can look through all of the funds there and see which ones you like the look of. For passive funds, I do like the iShares range because you can download all their holdings as a spreadsheet and you can easily access things like their fact sheet. This is the iShares Gold Producers ETF SPGP. Incredible performance year to date, but the longer term performance maybe not quite so impressive. We've got annual performance here. We've got some key facts about the fund, quite expensive in terms of fees. And then the PE ratio is a whopping 29, which is not particularly good value. And the price to book ratio is 3.28. That means for every pound that's kind of been invested in these companies, you've now got to spend £3.28 to actually buy the underlying assets. In terms of the holdings, we've got the top 10 here, and it is pretty concentrated around this top 10, but then that's just the nature of the gold producing industry. This is the performance of gold producers from 2011 to date, and you can see that they've fallen from 10,000 in the index down to 2,500. So that's an incredibly sharp decline. And then they've kind of bounced around a lot. And then really since 2024, they've shot up again. So the growth over this kind of like 14-year period isn't particularly great. So on one measure, you could say that maybe they're quite expensive because of the recent growth, but then maybe on a longer term basis, you could say they've got further to go. Here are the holdings of an active gold fund, in this case, Schroder Global Gold, and they don't seem to be that different from the iShares tracker, only the weightings are really what's been changed. So the active share of this fund is quite low, and given the fees, you might be better off just having a tracker. This is Amati Strategic Metals Fund. They've got the metal exposure here, which I think isn't particularly impressive because they've actually got quite a lot of exposure to gold and silver rather than some of the more rarer precious metals that are maybe used in things like the latest mobile phones. And then also for this fund, it's quite concentrated around small caps, which I don't particularly like. Some of them are potentially underfunded for what they're looking into, and that could cause problems down the road. And then it's also likely to mean performance is pretty volatile, which is really what we've got here. Massive underperformance for quite a long time, and then things have come back recently, but there's no guarantees as to what the performance of this would be going forward. So this looks like quite a high risk alternative. Here we're using the excellent website justetf.com to compare three metallic funds. We've got Aberdeen Future Raw Materials, Van Eck Rare Earth and Strategic Metals, and iShares Essential Metals Producers. The Van Eck fund is by far the most volatile. The Aberdeen fund, I think, has got some fairly consistent performance, although it is a very new fund. And when we scroll down, pretty much all at or close to all-time highs. Again, fairly expensive on the fees. The Aberdeen fund is quite small because it's only a recently launched fund. The Aberdeen one is actually actively managed, which is interesting that there are more and more actively managed ETFs coming to the market now, because I think they're quite cheap to launch, and I suppose they're going to appeal to the trading 212 brigade. When we come down here, we've got all the documentation if you're interested in it. And then we've got the top 10s, unfortunately, apparently not for the Aberdeen one as yet. And when we look at the essential metals producers, I'm not so impressed with things like BHP and Anglo American, because they're pretty much bog standard companies. And then maybe the Van Eck one is a bit too sort of wacky and out there. And when things are going well, I expect, this fund will do okay. But then when you get a turnaround in sentiment towards the sector, then I think this one is probably going to fall quite a lot. And then here's the top 10 holdings of the Aberdeen fund, along with the country exposure. Quite interesting to see China at number 1, which maybe makes it a bit riskier than I'd really like to see. So here's some information on the methodology of this Aberdeen fund. So the investment manager initially identifies the minerals that he wants to look at, and they've got a list there, and then how that selection is derived according for use in technologies, including things like solar panels, space satellites, and then allegedly scarcity of supply to meet the projected growth of demand. And then a portfolio is constructed using things like the valuation, profitability, earnings, and price momentum. And I do think the price momentum is quite useful when you're selecting companies to put into a fund. So I think this one looks quite interesting, and it would kind of complement an investment in a gold producing fund. So with all momentum plays, you need to tread carefully. If you are going to start investing in gold or gold producing companies, then it's probably best to buy in small amounts and add to your position as the price continues to rise. And that way you're limiting your potential losses. What are your thoughts on the recent explosion of prices for gold producing companies? Let me know in the comments. And in the meantime, you might be interested in this video.